Hey, welcome back to the Behind the Well show. I'm your host, Roger Abel. I'm here with Elias Randall. We usually record these podcast episodes on Thursday. With that said, last Thursday was Thanksgiving. We spent the day with both of our families, enjoying some much needed time together with them. So today we're going to do something a little bit different. If you don't know, Elias and I host a weekly radio show called the Premier Financial Hour, which is in its 17th year. We thought it would be fun to share a few of our favorite listener questions from the show on the Behind the Well show today. We hope you enjoy it, and we'll see you back here next week.
Hey, I've got a first question for you from Julianne, who is a viewer and a listener. She wants to know, we want to gift $25,000 from our IRA to our daughter and son-in-law. I know we will have to pay taxes on the distribution, but will we also be subject to a gift tax on top of that? Roger, what would you say to somebody who's such a generous giver like Julianne and her husband?
Doug, here's the answer I would give Julianne. If you structure this correctly, the gift will not be subject to any gift tax.
Okay.
As you know, on the show, Doug, we like to hear questions like this because we actually believe giving with a warm hand is better than a cold one.
Yeah.
Said that for a long time. And if you know you're on track for all of your goals, all of your objectives, then it probably makes sense to go ahead and do this. One thing that catches people off guard a lot is they hear what the annual gift limit is,
Right.
which right now is $19,000 in 2025. But that is per person, per beneficiary. And for our scenario, Julianne says the word we. So I assume she has a spouse. So in this case, she would be able to gift $19,000. Her husband could also gift the remaining $6,000 and stay under the overall gift tax limit.
Okay. This is something that's really interesting, too, when you take a look at this, because a lot of times you'll say, hey, maybe I'll need to consult a tax attorney, but this is one of those things where it's pretty cut and dried as far as this goes. You work with people on this all the time.
Very, very common question. It is cut and dry until you start going over the actual $19,000 per person per beneficiary limit. Many people think you can't gift $200,000 to your kids, and that's not accurate. You actually can. You just use up some of your lifetime exemption, which currently is $15 million per person. Okay. So unless you're going to just make a massive gift, most people have the ability to just go out there, gift what they want to do, as long as it's in concert with their values and the things that are important to them.
Nope, that makes sense completely at all. You can work with a financial professional. It can be incredibly beneficial to you because there are questions like this that you have, and maybe throw them into Dr. Google. Doesn't make sense to do that. Make sure that you're talking to a professional like my friends from Premier Investments and Wealth Management, because I would imagine you've got clients that have dealt with this.
There actually is a story that really comes to mind. I had clients who wanted to buy a house for their daughter. Their daughter recently divorced, wanted to help her get back on her feet. House was around $175,000. They had the exact same question. Let them know this wasn't a problem. We consulted with the CPA in this case as well. All they had to do is file a Form 709. That's the actual tax form. And then there's no gift tax that's actually paid. So the way to really recap this for Julianne, I think her heart's in the right place. As long as she plans her gift within what the IRS guidelines and limits are, I think it's a great idea to go ahead and take care of this problem.
All right, makes sense. By the way, Julianne's last name is Fries. Julianne Fries. Sorry.
Is that a bad dad joke for the day?
Yeah, dad joke. There you go. Better do. Like we go to Elias's first question from Steve. Explain the 4% withdrawal and how it works. Does the 4% apply to my total retirement savings, even if I'm getting income already from Social Security and a pension? Or how do those fixed payments factor into how much I should withdraw from my portfolio each year?
This is a triple. 3 questions in one here.
It's a ba-da-bing.
So, can I explain the 4% withdrawal rule? Yes, I can. It is a rule that's been used in personal finance. It's widely adopted and considered to be the safe withdrawal rate. So let's assume you have $1 million. 4% withdrawal rule would state you're going to take $40,000 annually from the portfolio. Next part of the question, does the 4% rule apply to my total retirement savings if I'm already getting income from Social Security and a pension? When people talk about that, they're only referring to your retirement portfolio. They're not referring to your fixed income sources such as Social Security and a pension. So let's talk about retirement spending and retirement income. 4% withdrawal rule. We have a different belief for spending money in retirement. I do think this is a decent rule of thumb that can give you guidance and get you on the right path. I don't think people should be designing their income strategy around this rule. And that's for
30,000 foot level you're talking about. That's what this is. The 4% is just like the big overview, right?
Yes.
Okay.
Yes.
You get down into the weeds with them.
A little bit. And it was developed by a financial planner. His name's William Bengen. He's revised the safe withdrawal rate over the years. It has a few assumptions. It assumes, I believe, either a 50% stock to 50% bonds or a 60% stock to 40% bond portfolio. And he's revised what he believes it is. I think if you were to just simply think about the returns over the last decade, you can pretty easily make an argument that people could be spending more than 4% of their total portfolio. Mm-hmm. So here's some let's talk order of operations on spending. If you just list these down on paper, fixed income sources, so Social Security and pension, mm-hmm. those are going to come first. And next is going to be your investment accounts. So IRAs, Roth IRAs, and then any non-retirement accounts that you have. Retirees typically spend money in 3 phases. The go-go phase of retirement, which this is when you first retire and you have increased cost of typically activities because you have more leisure time. Mm-hmm. And it can even just be gas in a vehicle. The number of retired people that tell me, I didn't know we were going to spend this much money filling up our vehicles in retirement. Mm-hmm. All you're eliminating is your commute to work, which is a fixed travel distance every day. Well, when you're retired, you might go to the donut shop in the morning and then go get a haircut. Oh, you know some people at the golf course hanging out, mm-hmm. so you're going to go do that. People, I think, underestimate. That's one expense I believe they underestimate, and a small one.
Right.
But the philosophy of the go-go phase is you're going to be spending more money, and I would tell you should spend more money.
You've earned it.
You have earned it. The next phase of retirement is the slow go phase, which is where spending starts to level off. So people who travel less. People who like to go shopping for antiques. What's that? What's the word for antiquing? Or
antiquing.
What's the show?
Junking. Oh, American
I can't come
pickers.
Up with the term. Picking.
Yeah,
picking.
Gotcha.
The people that like to go picking, go picking less. People that golf less. Mm-hmm. Right? You're getting to an age where you physically aren't. You can't keep up like.
Or
you're
emotionally, I'm done. I'm just like
or been there, done that.
Yeah.
And then spending transition to what we call the no-go phase. Mm-hmm. Your activity costs come down, and a lot of times your healthcare costs rise in that last phase of life. So we believe your withdrawal rate should be unique to you and those different phases of retirement. One very simple thing we can do is define what's your maximum spending. Well, if you look at what someone could maximum spending annually and spread that out over 35 years, that's going to be one answer. But if you tailor it to, let's say I'm 60 and I really want to go hard from 60 to 75. I want to do all these things. Mm-hmm. I want to spend my money. I'm not as concerned about legacy planning and leaving money for my kids. That's a totally different number, because what a portfolio can sustain for 10 to 15 years is different than what it can sustain for 35 or 40 years. So I think if I were listening to this and I'm curious on what can my withdrawal rate be, I would suggest a few resources. One, our website, premieriwm.com. I would request a retirement income analysis. And then I would also take a look at a guide that we've created. It's called the 10 critical steps to take before retirement. Let's get a unique spending plan put in place that is in concert with your goals and values and will, in a way, be your permission slip to spend the money that you've worked hard to accumulate. I don't remember who coined this phrase in our office, but you're either going to spend and enjoy your money or someone else will. So
Yeah.
I like to see clients spending and enjoying their money.
And what I think too, Elias, is I said this last week, everything's better in a bull market. If you have some milestone expenses now, if you want to help a grandchild out now with college expenses, in your balance sheet, your balances on your 401ks and your IRAs are higher. It's a lot easier to take withdrawals from your retirement accounts right now. When we're in a recession, even though your balances are a lot lower, it may make you feel, Doug, that you're not as wealthy.
Yeah.
And people are hesitant to draw on their retirement accounts during a recession. I've seen this before. I've seen multimillionaires that have severe hay fever that usually get their grass cut by the neighbor boy.
Yeah.
He or she's out there cutting the grass, blowing their nose like crazy just because we're in a recession.
Yeah.
And they feel
like they got to cut
they
back.
feel a little bit poor. They feel not as wealthy as they were before. So I would say go for it now. Get a financial plan, but everything's better in a bull market. Now is the time to take some money out of the retirement accounts that you have.
You know, I find these rates that we were kind of talking over on there, 3.3, 4.7, you know, all these different numbers, kind of interesting. I remember running a plan where we went and we ran through the rate. They had an 11% withdrawal rate.
Mm-hmm.
Now, it was for a 2-year period of time.
Right.
Right. So we basically front loaded a lot of the contributions or a lot of the distributions coming out of the 401k and then significantly dropped it a little bit later on. But for them, in order for their plan to run optimally, they were pulling a lot more out of investments. And we designed a portfolio that made that work. But they were pulling a lot more out of investments in the early parts of that retirement compared to a little bit later on when we were replacing those with other sources of income and other legs of the stool, so to speak.
Yeah.
I can think of 2 situations recently that I'm reminded of when Jonas says things are better in a bull market. Had a client call and ask about taking a large chunk of money out to remodel a kitchen. That remodel's paid for and gains in the portfolio. Why wouldn't you do it? Another lady called, wanted to buy a car for her granddaughter. It's all gains. Why? Like, what would stop you from doing it? It's all gains in your portfolio. Go ahead, buy her a car, right? And if you have this sentiment, well, I'm spending her inheritance, I think she's going to enjoy that car today just as much as she may in the future as well.
Yeah.
Here's that $5, Elias, for me. Making him sound good there.
And in reality, too, I think that part of that as well, Elias, is that you're going to have that psychological satisfaction knowing that you can watch their life become easier by having that car for them. You all say give with a warm hand rather than a cold hand, which is really one of those stunning things. It all comes down to having a financial plan. And again, if you want the 4%'s really a 30,000-foot thing, it's something that maybe you're thinking about it and you're thinking about retirement. You're going, and you're noodling over it and you're penciling out some numbers. They at Premier Investments and Wealth Management have custom software that's designed to do this. So you don't have to stick with a rule of thumb, okay? You can get something that's tailored to you to fit your needs very easily at premieriwm.com. Click Get Started. You can start there, or you can even call and make an appointment today at 800-383-6590. Thought a lot about some of the questions that we have here. We get listener questions. We're going through them. This one for you, Roger. John asks, I am employed full-time, have a 401k. My wife's self-employed hairstylist. She doesn't have a workplace retirement plan. We would like to retire early, so we've been prioritizing savings. We're now maxing out my 401k, still have a little extra we would like to save each month. We've discussed starting some sort of an individual retirement plan for my wife or investing it in a taxable brokerage account for more flexibility. What are your thoughts, Roger?
Yes. No, John, it's absolutely a great spot to be. The fact that you're maxing out your retirement plan, you have a little extra, you're on the right track. I think the few things I would start with is one, let's hit our goals and priorities. What are those?
Okay.
I think that when you set out to invest money, just investing more without a purpose isn't necessarily that meaningful.
Mhm.
And you might already be on track for retirement. So I think, one, let's figure out, are you on track?
Okay.
Two, if you are on track, how much do we need to be setting aside to be on track if we're not there? And a lot of times the timeline dictates that. I think John mentioned they want to retire early, so they might have to save more. Options for self-employed people. I think that's really what John's looking for. How do we do this in the best, most efficient manner possible? And one of the most popular options is just a solo 401k. And to really break it down into its simplest form for the listeners, it's just like John's 401k at work.
Mm-hmm.
They're just providing all the benefits for themselves, meaning there's still a employee contribution and an employer match.
Okay.
His wife is the employer.
Mm-hmm.
So it works just like a 401k. You can do Roth option in it. You can do the pre-tax option. It's identical for all intents and purposes. There is more upkeep to it. If you have more than $250,000 in that account, then you have to file an IRS Form 5500. That would be the downside because you likely would need to have what's called a third-party administrator involved.
Okay.
Cost you probably around $1,000 a year to do that. So that's option one.
Okay.
Is set up a 401k just like John has at his employer,
Right.
providing your own benefits. Option two would be a SEP IRA, which stands for self-employed.
Thank you.
IRA. And it's easier to set up. Contributions are tax deductible, but here's the cons. It's employer-only contributions, and there's less flexibility to make Roth contributions and loans.
Okay.
I didn't mention in the 401k that you set up for yourself, there is an option for loans, and some business owners like to have the ability to say, hey, there's an extra level of liquidity
Right.
to this account. So I think the way to end this is, yeah, congrats. Set up a solo or a SEP IRA.
Mm-hmm.
I don't think unless you are maxing out one of those accounts, it makes sense to do a traditional brokerage account at this point.
Right.
You might as well get all the tax benefits that you're legally entitled to do. I think John's on the right track.
Yeah. Maybe the most important thing is to sit down and put together a financial plan, Roger.
That's what I was going to say from an advice standpoint, Roger. I think you've had a solo 401k for as long as I've known you, for 20 years. And I recently received a phone call from a self-employed customer, and she didn't know what to do. And we went through the advice business. And I think that there's something to be said about not having to do this stuff yourself. How hard was it to set up your first solo 401k when you did it?
I wouldn't have wanted to do it if I wasn't in this business.
I teach you up with a little golf ball there.
But in general, it's not hard to do. But I think there's a level of compliance that may come with it. But the reason I did it, I can tell you personally, I did it because when I started, just like most small business owners, I wanted to save money, but I still wanted that like flexibility of, hey, if I really need it, I can go grab some of it in the form of a loan, which fortunately I never had to use. But it was always kind of my little backstop to say, hey, it's okay to go max this thing out and put a bunch of money in here because I still am building a reserve on the sideline.
And Roger's been so disciplined over the years. He approached me and said, you have to do one of these solo 401ks. But I had trouble, Roger, with cutting the check and physically writing the check as a small business owner because I knew that it was coming from working capital, and I knew I might need that money in emergency funds instead of retirement. So I was never able to cut the check in the 401k. That's another kind of a con of a solo 401k. You have to cut that physical check.
Well, that's behavior, right? So I'm most successful in that because I pay myself a salary every 2 weeks. I don't have to cut the check. It comes right off the top. It goes back to the behavior we talk about with makes people successful investors. I don't even know it's my money. It's gone before it gets there.
This is really neat because you get an inside look at what the professionals are doing, and they apply this same sort of focus to you and your retirement plans. It's the right mix of accounts, and it depends on what your overall plan is, your goals, your timeline, your tax picture. The way that you can do this is the Premier Vision strategy, that one-page Premier Vision document. Get started on that by going to premieriwm.com and click Get Started. Answer the questions. That one-page Premier Vision document will be the opening, the entree to that first meeting that you have. Free, no obligation consultation, and at the end of the meeting, they will hand off that document to you as well. So you can get started working with Premier Investments and Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams. All right, Elias, let's hit the question from Nicole for you. Says, I want to set up my investment accounts so they don't go through probate and are easy for my daughter to inherit. How do I do that?
It's an excellent question from a future-focused mom. Nicole, the first step to avoid probate is going to be having your beneficiaries listed on all of your accounts and probably doing some level of estate planning for the rest of your assets. Here's a good way to think about this. There's 3 primary assets people have that should have beneficiaries. Investment accounts, retirement accounts. Those are all the same. So your 401ks, IRAs, even non-qualified accounts, non-retirement investment accounts, bank accounts, and then real estate. So there's a few things you can do with each of those accounts to make sure they won't be subject to probate. So we'll talk retirement accounts first. And here's a good thing about retirement accounts. They require at least a primary beneficiary. So hopefully in this case, because Nicole wants the money to go to her daughter is the primary beneficiary of any retirement accounts that she has. It's possible if she hasn't reviewed that for a long time, maybe her parents are, or maybe a partner or a spouse, whatever that may be. So reviewing that, making sure it's correct. For your bank accounts and non-retirement accounts, you can typically add what's called a transfer on death or a payable on death endorsement. And any bank, any financial institution should have a form that you can fill out to do that. And then for your real estate, it's really good to have a revocable living trust established for your real estate, and that'll help that avoid probate. And then a will is a good thing to have for other assets.
Yeah, it makes sense. And, you know, it's funny that it makes me think of something. I was co-executor of an estate for somebody who did not change the beneficiary from one of the life insurance. So the money for everything was supposed to go into the pool and take care of everything. Well, the co-executor who was there in that with me, he was named the original beneficiary. That never got changed, and dude absconded with the money. I mean, didn't abscond because it was benefited to him, but it was supposed to go to the entire state. I mean, you got to remember to do these things.
So the purpose of the money in your story was to help settle all of the estate, and were multiple people supposed to get some money, or just was supposed to cover expenses?
Multiple people. It was, I mean, the whole
but
thing.
But one person was listed as the beneficiary.
That's correct.
So then that could be a simple misunderstanding of someone not understanding that, hey, the beneficiaries take precedence over the will that you have. I'm assuming maybe in this situation they had a will drafted and said, hey, this is divvied up between these however many people. With that life insurance, you said? So the life insurance designated that person as the beneficiary. So they're going to keep the money, or they will inherit it, and then what they do with it's up to them.
Exactly. Now, one of the things I know that's like every year, at least once a year, I rebalance my portfolio. How often should you be checking into these things so you make sure that all your ducks are in a row as far as who you have in what places?
There's a couple good rule of thumbs to follow. It wouldn't hurt to review these things annually. Certainly if you have life events, death in the family, get married, get divorced, birth of a child, you have a child turning 18. Life events are a good time to review. I don't know what would stop someone from reviewing annually. just to make sure everything's still correct.
Okay.
I think here's the takeaway, and here's what I would do if I was listening to this and I'm thinking, you know what, I'm not sure if I've done that. Work with your professionals, your financial professionals on your investment accounts, bank accounts. If you own real estate, you need a will, work with an attorney to get those things put in place. And hopefully that proactive work will then make sure your plans are aligned with your goals, and then you're going to get the outcome that you hope to get, as opposed to the outcome in your situation where one person got the money, but there were supposed to be other people involved, and that didn't happen.
Yep, that didn't happen. It was a difficult situation. Roger, before I hit you the next question, it's one of those things I think that you've talked about before is having the red folder or the blue folder,
The blue
whatever.
book.
The whole point is like have a lot of these things there in one place at one time so that you know what they are, you know where they are.
In our household, we have the blue book.
That's it.
And it has everything in it. One of the nice things about getting a financial plan done is it forces you to get these documents organized. When you do a plan, all of those policy numbers, account statements, beneficiaries, all of it gets reviewed. So that's one of the benefits of doing this financial plan is organization, knowing where it's at. Even if we have a customer that we don't do the insurance for them, we know that it exists. So in those cases, we'll have clients call us after a death and ask, do you know if we had anything else? In fact, Elias, I think of one that happened a year ago. Gentleman passed, it was 2 years ago. Gentleman passed away, had 2 outside insurance policies that he'd had forever. We helped them settle that death claim, even though we really had nothing to do with it. Had we not done the financial plan, who knows how long it would have actually been before somebody would have known that those existed.
Yeah.
If you go look up how many billions of dollars are unclaimed in insurance every year, people forgot they had it, beneficiaries didn't know that they had it, and they're just sitting out there waiting to be claimed.
Well, we had a situation where husband and new wife came in, and the new wife was reluctant to give the financial information, and we uncovered that the original wife was listed on the pension as the beneficiary, and that's not the way that they wanted it to be in the future. So it's a great organizational tool.
In that situation, it could have been because of a previous quadro.
Right.
You mentioned earlier, Elias, making sure that we check beneficiaries at life events. Most people don't realize what you said earlier about beneficiaries, that they supersede a will in all cases. People go and say, I have my will done, and they forget about all the other stuff. And the will is one part of the estate planning that needs to be done.
Okay. Speaking of estate planning, we're going to move on to another question about long-term care policies. Roger Abel and Jonas Everett and Elias Randall with us here, Premier Investments and Wealth Management. PremierIWM.com is the website. You can make an appointment there. Also, just click Get Started, answer a few questions. You get a one-page Premier Vision document. What's cool about this is that they actually are able to put together for you very visually pleasing idea of how to get ready for retirement. Like I said, it's one page. They can expand it to 150 if you want to, but the whole point of that one page is you get a free no obligation consultation. They'll sit down with you either in person, they'll do it over the internet, they'll come to you however you want it, and they will go over this with you. You get to keep that page, okay? You determine whether you want to be a client. I think that you're going to want to be. I know that I've made that choice because that one-page Premier Vision document makes it very easy to take that next step toward investing in retirement. Again, PremierIWM.com, or you can call for your appointment, 800-383-6590. Premier Investments and Wealth Management, named to Forbes 2025 Best in State Wealth Management Team.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in the show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Rebalancing a portfolio may cause investors to incur tax liabilities and or transaction costs, and does not assure a profit or protect against loss. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Contributions to a traditional IRA may be tax deductible in the contribution year, with current income tax due at withdrawal. Withdrawals prior to age 59.5 may result in a 10% IRS penalty tax in addition to current income tax. Consult your tax professional about eligibility to Roth and traditional IRA contributions. Contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59.5 and has held their Roth IRA for at least 5 years. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This recording contains only general descriptions and is not a solicitation to sell any insurance product or security, nor is it intended as any financial or tax advice. For information about specific insurance needs or situations, contact your financial professional. This recording is intended to assist in educating you about insurance generally and not to provide personal service. They may not take into account your personal characteristics, such as budget, assets, risk tolerance, family situation, or activities which may affect the type of insurance that would be right for you. In addition, state insurance laws and insurance underwriting rules may affect available coverage and its costs. Guarantees are based on the claims-paying ability of the issuing company. If you need more information or would like personal advice, you should consult an insurance professional. Forbes' Best in State Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings, and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firm. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.